Please give a warm welcome to James Anders, our first panelist.
I'll just go through my presentation and you'll just take my word for it. What I'm saying should be on there and it would be. Again, my name is James Anders. I work for GQG Partners. The firm was actually founded in founded in June of 2016 by Rajiv Jain, who was former CIO and co-CEO of Von Tobel Asset Management, where he managed 3 strategies: global, international, and emerging markets. I think total assets under management when he left was about 50 billion. He left there, and again in June of 2016 opened up GQG. And we're based in Fort Lauderdale right now. There's 46 professionals working there, 13 on the investment team, which includes 7 analysts, a couple of investigative reporters, which I will get into what that role is, 3 traders, and Rajiv, who considers himself an analyst first before portfolio manager. And we have a strategic partnership with a company called Pacific Current Group, which is based out of Seattle, that assists us with some of our overseas marketing as well. And basically the strategy, GQG stands for Global Quality Growth. The idea is to find quality companies around the world that have attractive forward-looking growth metrics. So when we talk about quality, we talk about growth, we're not looking backwards, we're looking forwards. So the idea is to look out 3 to 5 years and try to get an understanding of the business, the opportunity they have facing them going forward, and look to get double-digit compounded returns over a 3 to 5 year market cycle. Right now we have 3 strategies, as you can see. We have a global product, international, and emerging markets. Across them we have multiple vehicles, so we have 2 40 Act funds. An international product we co-branded with Goldman Sachs. And we have our own branded emerging markets 40 Act fund, as well as some SICAVs and some commingled products for institutional investors. Right now, assets under management are about 12.5, 13 billion. So Rajiv's reputation certainly has helped in the money raising side of things. So why GQG Partners? First and foremost, when Rajiv set up the firm, he wanted to make sure that there was a clear alignment with clients. So in order to achieve that, what are the things we put in place? 80% of his net worth is invested in the products alongside clients. All the investment staff and all the employees actually have investments in the products as well, so we kind of eat our own cooking. We restrict private trading. There's no PA trading allowed in single names for any of the firm members, and no soft dollars. And the idea is keep us aligned with our clients, make sure that there's no conflicts, and that we're all kind of, you know, Rajiv always says it's an honor to manage people's money, and we're trying to respect our clients and what we're trying to do for them. On the fee side, kind of fair and reasonable, so we're going to be kind of median or slightly below. Again, the idea behind that is we don't want to have a conversation with a client a year or 2 after they've come on board having to talk about fees. So we don't want fees part of the conversation. It should be all about performance and what we're able to do for you. The reason why we came down here, why Rajiv actually had moved down originally with Von Tobel about 8 years ago, because he wanted to kind of get away from Wall Street groupthink and be in a situation where he can be kind of separate from all the noise and distractions that can go through the, being in New York with all the companies coming through and potential investors, and really just focus on the portfolio and kind of keep himself away from a lot of the noise that's out there. And the other thing you want to do is have a well-capitalized company that investors on the institutional side as well as retail would be comfortable investing with us and not be concerned that we're kind of going to have issues about our business surviving, the next 2, 3, or 4 years. So we put a great deal of capital in to start the business, hired a bunch of smart people, opened up all the different products. So we both have retail products as well as institutional. And so kind of, as I say, kind of build the really big pipes, and then hopefully when you turn them on, things start to go, and you kind of a stable business to go forward with. And the last thing is private structure. There are actually a lot of people who did not want to invest with Rajiv when he was Von Tobel because he was part of a larger public company, and some concern that emphasis is not on performance or on fund size, it's on gathering assets, and gathering more and more assets, and that became potentially, that's what people's focus is on, and you can get too big, too unwieldy, because you have people just focus on bringing assets in, not really focusing on performance. And actually, if you look at our current investor base, I think more than half of it is actually people who have not invested with Rajiv in the past. So that goes to say, so it wasn't just a function of that he ran a big shop, he left, and he brought a bunch of money with him. It really is a function of he has a very strong reputation, and setting up the boutique private firm was what a lot of people were actually waiting for, and were able to move over when he did launch. So here's just an idea of the team. We have Rajiv's portfolio manager. As I said, we have several analysts, all with a great deal of background and experience, and we have a couple of kind of slightly different than typical team members that are investigative journalists. And I'll kind of go through that a little bit in terms of what that role is, because I think it's something unique that not a lot of people are doing, but a lot of times when people hear about it, they're kind of like, wow, that's a good idea. I should have thought of that. So, okay, what do we do? Okay, how do we do our work? Kind of a research mosaic, as he likes to refer to it. So we have traditional buy-side analysts. Someone like myself, I've been on the buy-side over 20 years. I have long-short experience. I actually have fixed income as well as equity experience. So I kind of come to the table with a slightly different mentality than a traditional buy-side, long-only equity person, because I spent my time doing credit, long-short, as well as equities. We have a team member who has a background as a forensic accountant. So he will come in sometimes on certain names and kind of review the accounting, make sure that everything's up to snuff and there aren't any kind of hidden problems that we need to be focused on. And then again, as I alluded to, we have two people on the staff who are investigative journalists. So really what their role is probably the best way to think about it is kind of an in-house expert network. So what they'll do is they'll go out and they will talk to former employees of companies that we're looking at, or they'll talk to regulators, competitors, suppliers, vendors, customers. And their role is to kind of get a better sense of kind of the culture of these firms, because a big part of the quality that we look for is a function of management and reputation. And so what they'll do is actually they'll go in, I'll just give you a quick example. We were looking at a couple of banks in Brazil, two large private banks that from their kind of looking at their numbers and from a traditional fundamental analysis, very similar. So it's kind of hard to know really which one was better, what can you find out that's kind of not in the numbers. So our investigative journalists went through and spoke to a bunch of former employees at these banks and other people in the industry. And the consensus was one of the banks was much flatter organization, much more cutting edge, much more of a meritocracy, much more willing to go and try new things, move the bank forward, and not be kind of stagnant. And the other bank was much more structured, much more hierarchical. They did not really have an interest in finding new ways to make money. They kind of watched the other bank do things, and if it worked well, they would kind of follow them along. And so with that kind of final piece, we were able to make a decision which bank made more sense, which was of higher quality. And that was that's how they fit in the process as kind of the culture, the kind of softer stuff that's out there. So our investment approach, philosophy, right? We're looking for owning high quality businesses over the long term. The market offers very limited opportunities to yield an information advantage in the short term. If you think about most sell-side research these days, it's focused on quarterly numbers, or end of year numbers, maybe get FY1, FY2 at most. So what you can create is, if you do enough work on the business and on the firm, you can get kind of what they call like a time arbitrage. People aren't looking out 3 or 5 years. They're not thinking about how this business is shifting, where their long-term opportunity set is. They're focused on what's the next quarter going to be, or maybe end of the year. So be able to look past that and kind of do a deeper dive and get a better sense of what the real opportunity set is for the business, it gives you an opportunity to generate alpha. And the other absolutely very important part of this is risk management. Rajiv's history is he's captured around 80 to 85% of upside in markets, but only 70, 75% of downside. So the idea is the market's going to be up 35%, maybe we'll be up 30, which is still not bad being up 30%, but more importantly, if the market's down 20, we're going to protect your capital better, and we're not going to have that type of a drawdown. So then looking at our approach, again, we look for companies that have superior outlooks. And again, when we talk about growth, it's forward-looking growth. So look for companies when we do our kind of screening is, who has above average ROE, who has above average margins, operating margins, why do they have them, are they sustainable, are they able to protect their business, are they unique positioned in the marketplace, and if so, is that going to be an opportunity that's going to continue for the next 3 to 5 years that gives us the opportunity to compound our returns, again, double digit over a full market cycle. So how does that process work? We deploy a screen because we're global investors, so you're looking at 50,000 companies plus. We'll screen out, and what's important about our screens is none of them have valuation metrics with them. So they're all kind of more fundamental, less changing on a short-term basis. So we'll look at ROE, ROA, low leverage, market cap over 1.5 billion, companies that clearly have some sort of sustainable advantage in their business or their sector. And from there, we'll have, say, 350 names. That's when we'll start to do kind of a more fundamental bottom-up research, build models, speak to sell-side analysts, speak to the company, competitors, and try and reduce that pool to a smaller subset. And probably not next to our next speaker when he talks about concentrated, is a little different than us, but we'll have 40 to 80 names. So if you think about, we're running 13 billion, 3 different strategies, but we only have 107 distinct names across all 3 strategies. So it's definitely concentrated, 40 to 60 names in our global and our international product, and 60 to 80 in our EM. So we got to be right when we put names in the portfolio because we're making concentrated bets. The top 10 will usually be, call it close to 60% of the portfolio as well. So you really got to know these names, and you got to know them well, because survivability in this business is avoiding blowups. So if you're able to avoid blowups, you'll actually find it's much easier to survive and keep going, as we've seen in so many other places. So our research process, I kind of talked about it. So what will we look at? Past results obviously matter. So we'll try to understand the business strategy. What's their accounting like? Is it aggressive? Is it conservative? Do they need to raise capital? Do they have a strong and defensible franchise? Kind of what's allowing them to have above average margins, above average returns on equity? Is that sustainable? Looking forward, what kind of growth potential do they have? Are their earnings able to compound on a go-forward basis at double digits? Because when we think about the companies we want to invest in and what we're doing, is we don't want to be reliant on the company, the market revaluing the company. We're fine if we buy a stock at, say, 20 times PE. If it stays at 20 times for the next 5 years, that's fine, as long as they're growing their earnings and their dividends by double digits. We'll be fine, and we'll be able to get compound on a double-digit basis going forward. And you see, the last thing actually we look at, see is valuation. We're looking at 5 years. taking a 5-year forecast, and then actually, I have an example what it looks like. So this is kind of how we think about things, right? Project out 5 years of earnings, take that year 5 number and give a multiple based on what historically it's traded at, and that gives you kind of a future value for this business. You can combine that with the dividend stream, what they're going to be paying out dividends over those 5 years, and you discount that back at a discount rate. It gives you essentially a present day business value. So you say, okay, the company's worth, say it's going to earn $1 in year 5 for a 10 multiple on it. That's a $10 intrinsic value. And say the dividend stream equals another $3. So that would imply that the present day value of that company is $13. So we can buy that at a discount. Obviously, you want to get enough of a cushion that you can be wrong on valuation and still be able to make money on the trade. So another example is if you have a company you buy at 25 times PE, but it's growing its earnings over the next 5 years at 25%. That stock can actually trade down to 20 times multiple, so you actually have a serious shrinkage in valuation. Your earnings will still grow enough that even at 20 times at the future value, the return you get will be, again, kind of double digits and compounded over time. So we don't want to be focused, like I said, purely on the market recognizing the value and revaluing these names. We're focused on what's their earnings stream looking like. Is it defendable? Is it going to be growing at double digits going forward, that we're able to not worry about what the market thinks about the name and how the multiple may shrink or expand just on kind of macro things that are going on outside. So here's some guidelines for our portfolio structure. Position size maximum for one name is 7%. Number of stocks, like I mentioned, 40 to 60 for global, international. Emerging markets, 50 to 80. We have at least 5 sectors at all times. Maximum country exposure is 20% over the index. No restrictions on market cap, but we're cognizant of liquidity. So ideally, we want to have a name that trades called $10 million a day or more. Volatility-wise, tracking error, we're benchmark agnostic. So, as we like to say, we don't need to fish in every pond, just the ponds where the really big fish are. So, if I go to Rajiv and say, hey, this E&P name looks really interesting, I think we need exposure to oil. His first question is, I don't need to own oil, tell me why this is a quality company, and that's kind of the starting point for our discussion. And then again, the greatest risk is getting the business wrong. You want to be diversified, but again, you need to be careful if diluting your process. And again, we focus on absolute volatility, not relative, and absolute return, not relative return as well. So that's it for the formal part of the presentation. I don't know if anyone has questions, or you want to wait until the end for questions? Sure.
Thank you very much.
Thank you.
Oh, I do not waste your time. Bill has given an excellent briefing on you, and I'm going to just say, welcome, Steve, and please tell us about yourself. I saw a little longer currently, so...
Yeah, I am not a charter holder, which I guess is, so saying makes me the imposter in the room, but then again, I guess it could be worse. I've been singled out as a lawyer as well, which usually, about then when I could see actually a few people grimace, and what I usually say in response is that I used to be a lawyer, but I got better. A great value opportunity. Just a quick overview of the firm and the fund. It's funny actually, because I was thinking about this presentation, and as I was driving down, and the rush hour traffic on 95 can do funny things to your brain. And for some reason, I thought of Macbeth, and I was certain that Phil would appreciate the reference. That final scene in the fifth act, where he's standing there and he says to Tomorrow and tomorrow and tomorrow creeps in this petty pace from day to day, to the last syllable of recorded time. And all our yesterdays is lighted fools away to dusty death. Out, brief candle, life's but a walking shadow, a poor player that struts and frets his hour upon stage and then is heard no more. It is a tale told by an idiot, full of sound and fury, signifying nothing. And as that came to mind, I thought, of course, why am I thinking about this? And I think it's because those last two phrases really resonated with me and ties into the investing. This full of sound and fury, signifying nothing. A lot of what we do, a lot of what we're trying to accomplish in capturing returns by identifying mispricings is distinguishing the sound and the fury from the reality. And it's a theme that runs obviously throughout existence, and you touched on as well. I mean, it's always there. And before anybody starts to panic and think that I'm going to lead into Chaucer, I'll get back to the slide. The firm's been around for a little while, since 2010, and we launched the fund in late 2014. We've got a very flexible open mandate. We'll look at anything, any geography, any instrument, long, short. We're primarily long. We look for instruments that in any given situation give us the most favorable risk reward and generally the most torque to the return. So we tend to be further out in the cap structure, very often in equity, but the prevailing theme is the extreme mispricings. That's what we're looking for. We are, as it mentions, quite concentrated, predominantly long, no leverage. Our brief bios, you've heard about me. Ryan, my colleague, is back in the corner there. Let's hear it for Ryan. If anything, he tolerates me. You saw that on the first slide, unmistakable alpha. We went through the trouble of trademarking that phrase because we wanted to make a very important point crystal clear. As you know, the business has changed tremendously in the last 15, 20 years. If you want to capture the S&P 500, you can go to Vanguard and buy it for 4 basis points. So if you're going to charge any kind of substantial fee for what you're doing, your return better be distinguishable from beta. Now, the alpha part of it, of course, is what we aspire to. And there are no guarantees there. But what's the best way to ensure that nobody can ever accuse you of closet indexing? It's concentration. And that's the easiest way to guarantee it. We run a portfolio of 10 to 20 positions. That leaves us very little place to hide, and now that we've been in business for a while, certainly there is no correlation between us and the broader market. A fund that concentrated, it doesn't occur. When we talk with investors about what we're trying to accomplish, again, if you can get the S&P 500 and hold it over the long term and say make, I don't know, 10% with dividends over the extended long term, how do we beat that? It has to be focusing on extreme mispricings. And the way we put it is that extreme profits require extreme mispricings. And extreme mispricings, in turn, require extreme misperceptions. What are the 2 places that you're most likely to find that? It's either going to be something contrarian or obscure. If we own it and you've heard of it, well, for long, everybody probably hates it. And the rest of the portfolio, most people have never heard of the names that we're in. I think there's a competitive advantage to the concentration beyond what I've said thus far, in that, we have a very open mandate, and which means no matter what the market conditions are, throughout the entire globe, we have to find 10 to 20 attractive opportunities. We have to deliver on that. But I think as a basic premise, it's reasonable, it's logical. We should be able to find 10 to 20 decent opportunities, regardless of what's going on globally. We frequently get put into the value investing category, and we're certainly receptive to that. It's intellectually, it's a common provenance with Ryan and I. But when you think about it, that's Benjamin Graham if you don't recognize his handsome visage. What is an extreme mispricing but an extreme margin of safety? Really. And so what we're doing is very much, I think, in the value tradition, we're just taking it to more of an extreme. The wider the mispricing, the wider the margin of safety, and theoretically, the greater the return. So there it is up top, kind of summarized. Invest in extremely mispriced securities that provide an irresistible risk-reward profile and potential for extreme profits. That really is what we're trying to accomplish. Now, what does that mean in practical terms? We do average between 200 to 400 hours of research per name. And you really have to be disciplined on price. We have names in the portfolio now, at least one, that we followed for over 10 years before pulling the trigger. What happens is we follow a lot of names. We get involved, we find intriguing situations, but if the market is efficient most of the time, then it's unlikely that you're going to find something that's really interesting that is also really mispriced. And so then what we generally wind up doing is following it and waiting for either an asset or company-specific event or a market-wide event to give us that opportunity where it creates an air pocket. Obviously, that last two lines there are really important. Investors have to understand, and it's incumbent upon us to make sure that they do, we don't equate price volatility with investment risk. Ultimately, we're in the business of converting short-term price volatility into long-term returns. That's absolutely pivotal. Now, again, the value category, a lot of what we do is kind of traditional deep value investing. We find great businesses, great opportunities that we think are extremely mispriced. They are the classic value investments. You know, what's the cliche? These are businesses you would want to own forever. But we also engage in what we describe as rational speculations. Those are short-term long positions where it may not be a business, for example, that we would want to own. It may be an entirely mediocre one, but it is so extremely mispriced that the risk reward is attractive. It's a rational speculation. And then there are the shorts. We don't short very actively. We don't attempt to build a short basket. I don't know anyone who does that successfully in terms of assembling a basket of shorts that ultimately doesn't diminish their long-term returns. As it notes, and I mentioned before, we don't employ leverage. That's absolutely key. Think about it. If you're dealing with significant short-term vol, you're not going to be using much leverage because that would be very detrimental to being able to employ the strategy effectively over the long term. We do practice risk management in terms of how we size positions. The maximum position size is 10%. We average between 5 and 10. It's 10 to 20 positions. The math is pretty straightforward. The maximum sector exposure as shown is about 40%, but we tend to be below that. I included this because this is really just a summary of what I've been talking about. But the box all the way to the left, some of you are probably wondering how we actually generate our ideas. As shown, I've bullet pointed some sources there. But what it comes down to is we just take in an enormous amount of information over the long term. Both Ryan and I begin every day spending just 4 or 5 hours hoovering in information from periodicals, from different news sources. You know, you find out about a company that's big in hydraulics, and then you go ahead and spend however long it takes to read the last 5 years of Hydraulics Quarterly or whatever the vanity publication is. But we're also taking in information from broad sources, and every once in a while, you run across something that gives you pause. And then you've got the kernel of an idea or an opportunity. And it's extremely time consuming. We don't use screens. We don't use Wall Street research. We don't use any of the typical means to develop our ideas. That does lead to generally what would be characterized as a very esoteric portfolio. But then again, when we're thinking about, you know, beyond the return, the institutions or the investors who are looking for a non-correlated return, an esoteric portfolio will get you there. Hedging. Again, we will short, but only occasionally. We basically believe that, as I included in the slide there, that, you know, the best way to prevent losses is to avoid losses. I know it seems like I'm being coy, but that's really what it's about. I mean, if you went to an investor and said, okay, I could assemble a portfolio of shorts and run it, and that portfolio would probably decline in value depending upon the severity of the market reaction. Or I could not have that and just minimize losses. Which would you prefer? I think they would prefer the latter. And so that's what we shoot for. Obviously, concentration demands a certain vigilance when it comes to loss avoidance, because if you have 10% positions and 2 or 3 of them go south, where you've got a truly significant impairment of value, that will destroy your return. So we are out there. For the investors that are looking for alpha, we are pursuing alpha. And based on our approach and how we structure the portfolio and manage risk, we have left ourselves nowhere to hide. Kind of a simplistic graphic, but that's basically what we describe to investors. Now, before I get to the next slide, if you think about it logically, the one issue with extreme mispricings is that they never correct quickly, or very, very rarely. If everybody hates it, whether it's a company or an asset class, or considers it doomed, it's not going to be rated a buy 3 months later, 6 months later, probably not even a year later. So what's going to happen is, and we found this out, when we launched the fund, we told investors that you probably want to think at least 12 to 24 months out for a position we put on to correct, and it'll probably trade against us in the interim because everybody hates it, or it's very, very obscure and will take a long time to correct as a result. And so when we launched the fund, we launched with a 100% cash position. And so you're starting with cash. Now imagine everything you buy trades against you. It looked like we were going through our investors' cash with a blowtorch. Basically like that. You can see the first year was just horrendous. Now again, we take informing our investors of our approach and getting their buy-in really seriously. We don't have a lockup and we don't have a gate either. So they can leave whenever they want to. But as indicated in the green to the far side of the chart, 90% of our positions were in the black by the end of year 2. There has to be an appetite for that initial volatility, for owning what nobody else wants to or nobody has heard of. These are actually what our returns looked monthly. So we had this launch phase that we call it, because you're never going to start with 100% cash again. And that's that first year. And then you can see once we transitioned out of cash, where you had positions now, there's very little correlation between these positions because they're all strange. Which means once you're out of cash, you've got positions offsetting one another. The volatility is naturally offsetting because there's very, very low correlation. Through the end of last year, the fund has had no losses. We've had no impairments since we launched the fund 3.5 years ago. This is just through the end of the year. All 13 positions we exited were profitable. And as you can see at the bottom, approximately 80% of the fund's 30 positions since inception were profitable, and there have been no realized losses or impairments. This is actually what the performance looks like by position. On the left, and again, this is as of the end of this past year, you can see current positions. There's 17 of them. And on the right were the positions that we exited, and you can see the returns that we earned on those positions. The color coding indicates actually partial exits. Those are positions where we still own some of it, but we also exited it. I feel compelled to mention that one return where you see a number 17 is negative 99%. Actually, we wound up exiting most of that position at a profit. If that goes to zero, we're still holding it. That will be our first loss, and we'll probably be in the territory of a $19,000 hit. Any questions so far? How am I doing on time? Beyond just talking about who we are and what we do, I thought I would try to share with you something that might actually be useful for those of you that are running portfolios. And occasionally we run across a theme that we think is particularly fertile when it comes to application beyond just one position. And what I'm about to show you is what I would refer to as a reporting arbitrage. Imagine a company that is overseas. This should appeal to a CFA audience, by the way. I'm counting on it, but that was certainly my expectation. Imagine a company that is, let's say, overseas, somewhere in Latin America, and they're actually doing quite well locally, despite the volatility and political issues that countries in South America will experience. But their legal domicile is the US, and they report in dollars. So what happens? Because of that turmoil, their reporting results start to look worse and worse. Actually, they get ugly really, really fast. But they recycle most of their capital locally. When you think about the working capital of a business, they're earning locally. Most of their expenses are local. The only thing you're really looking for to make sure they don't have exposure to is, say, dollar-denominated debt. And let's say we're talking about dollars because we're sitting here in Florida. Now, companies, you've already read about companies with the markets over the last few months where they're concerned about a lot of emerging market companies that have dollar-denominated debt. Their currencies have plummeted, but some of them don't. Some of them who are smart borrowed locally predominantly, and as a result, they're not exposed to that, but the shares have traded down regardless. Largest franchisee of McDonald's, Arcos Dorados. I've got some information up there. I don't want to resort to just reading the slide. I can send you the information. I've got a report that we wrote up on it. This is a company I started following when it was trading up around the mid-20s. All of the hedge funds were piling into it. It sounded like a great story. It's McDonald's, but with much better growth prospects because it's in faster growing markets, really professional management, a great story. In terms of how deep we dive and how early we're getting involved, I was following this company before it was public. So what happened? It started to trade off because the currencies that it was earning its revenue in were declining relative to the dollar, so its reported results were plummeting. But if you backed into the local numbers, you found a company that was actually performing astonishingly well, even as Brazil was going through all the difficulties you've read about in the last few years, the scandals. They've got significant exposure to Brazil, Argentina, Venezuela. Venezuela is going to pieces. These guys are still selling yuca fries there. Fantastic management team. And so what did we start to do? We watched and watched and watched. And of course, this is definitely more art than science. And when it got down around $5 or so, we started to accumulate. You see, we wound up capturing an average cost of a little over $3. And it was a sizable position. Again, risk management. We're very careful about knowing when to be the analyst and when to be the risk manager, at least I am. Because it was a big position and it appreciated significantly. We had to downsize it, just capture the profits. We still have a position. I made this chart pretty recently. I really suggest you take a look at this company. It's very interesting. Great balance sheet, really executing. Is my time up or? Huh? We can switch to questions. I've got more charts, but you know, I don't want to bore you.
Yes, so normally the charter holders are truly excellent at grilling the panelists on their stock picks and all kinds of technical and what's in their portfolio and why. I did have a talk with James Andrews before. GQG has some legal restrictions because of the nature, and they're not allowed to give individual positions out as part of his legal restrictions. But you are absolutely able to grill him on sectors, on anything that isn't a specific name in his portfolio. And we have already found out that you obviously can, I assume, grill Steve on the individual positions, or at least you had a few for us, because he just presented.
Fun to grill him, I think. We can agree.
But I hope our charter members have a few good questions. Please, Mr. Murphy.
So my first question, and I'll let others ask them.
Yeah, can we wait for just a mic for a second? Thank you.
Both of you have a value component. Either way, you use the stop loss as a risk management technique, and if not, what is the trigger for admitting?
We don't have specific stop losses. It's more a function of if we're not comfortable with the name, we'll just sell out of it, take the loss, and reassess. Rajiv likes to say, when someone asks him what stock keeps him up at night, he says none of them, because if the stock's keeping him up, he's going to sell it. So we'll take a loss quickly if our sense of what the story is not panning out as we expected. So it's not necessarily a price issue. It's more a function of is our thesis on the business changed? And that could be either a function of new information, new news, or geopolitical, some macro issue that's out there. Macro for us is a reason for risk off, not for risk on. So it's a function of lack of comfort with the story, more so than stock price.
Okay, and Steve? Same
What
question?
he said? Actually, I can, if you want to do a confessional.
Yes, and I have to figure out how we're doing with the mic. If we give it to them, then the panelists can. Here's a.
This, you can hear me if I'm, yes.
Yeah, you have a. Yeah.
This is obviously one that went wrong. Really interesting company, two primary businesses operating river barges in the Hidrovia region of South America, and a really profitable annuity-like business providing platform supply vessels primarily to Petrobras. Everybody familiar with what happened with Petrobras? Yeah. What they call the car wash scandal engulfed the company, They started selling off assets. We thought, okay, we're good because they've got to keep the platform supplied. Even if the thing winds up in receivership, whoever that judge is going to want to keep the cash flow going, and these platforms are creating cash flow. The problem was, in the process of going through the very complicated legal processes that they entered into, which a lot of them were sui generis because the Brazilians had never dealt with anything like this before. That's a problem with a law degree. It enables you to appreciate the full terror of what you're in now. They decided that they would only utilize platform supply vessels that were flagged under Brazil. And the company that we had invested in was actually based in Argentina. So all of a sudden, the fleet was basically mothballed. And they went from generating collectively about 50 million in EBITDA a year to costing, what was it, Ryan, about 20 grand a month a piece to mothball. So, and you can see here, right about here, that Petrobras terminated 3 PSD contracts. So what did we do? We got involved in the reorganization process. I spent a number of years co-managing a risk guard fund. I was kind of familiar with the mechanics and some of the dynamics. And when the shares sold down to almost nothing, about 10 cents, we were buying aggressively in 100,000 share blocks. Because these processes always have a certain interim volatility, that enabled us to go ahead and unload a significant portion of the position at a much higher price, more or less neutralizing the position. We were wrong. We didn't see it coming. You couldn't see it coming. It's one of the reasons that you have size limits. You know, one of the ways I describe our risk management in that regard is that the size limits are how we protect the portfolio from us.
Okay, thank you, Bill. Next question? Steve Hansen?
Maybe sort of in a short form, but could you just touch upon quickly your self-discipline? Is it based on valuation, the story, deceleration of, some aspect of the financials? What is your for both of you, what is your typical self-discipline?
Generally speaking, it's going to be a function of our thesis on the business changing, whether it's new news, new information that comes out that we didn't account for or did not expect, that changed our expectations for future growth for the business. Whether it's a new technology coming in or new competitor coming in and squeezing margins. And we do obviously have price targets on our names. So that's also a function of if it hits a price target and the upside left in the name is not attractive to give you kind of double-digit compound over a 3 to 5 year period. We'll exit. Because we're just buying stocks, essentially we're buying the portfolio over again every day. So every day you have to look at that name and make a decision, do I want to own it or not, because I don't have to. So it's going to be some sort of change in the story or the expectations. And there are stocks that Rajiv had even at Von Tobel, so he's owned his name for 15, 20 years. They just keep compounding and keep riding them. But as soon as that story starts to change and there's a level of discomfort with the forward-looking outlook, we'll like the position.
Again, I have to begin by saying what he said. I can illustrate by way of another example.
Okay. People like examples.
I made the charts, so. Remy Cointreau, great company, traded up dramatically when the Chinese government, the Communist Party, came out and cracked down on ostentatious gift giving. Huge market for their cognac. Stock went off a cliff. But How realistic is it that cognac sales in China will be depressed forever? What about sales elsewhere in the world? This is an aspirational purchase for people who are entering the middle class. How many billions are entering the middle class across the emerging world? So we started to build a position. Really strong balance sheet, great business, and truly, you know, just like says that title, what is the replacement cost of a truly irreplaceable brand? You cannot invent a cognac that's 250 years old. So these are really powerful brands. The value of those brands is reflected in the multiples that they get. When Suntory bought Jim Beam and went for 20 times EBITDA. They'll get up that high. That's about 20 times EBITDA. It kept going up, but eventually you get to a point where you just can't make the valuation argument anymore. It's one thing if it's fully valued, it's another thing if you're getting up into what are really significantly elevated valuations relative to every other comp. That's another reality check for your valuation.
I'm going to ask a question on my own, and then I'll go to the... So I'd like to know what each of you think, and this time I'm going to start with Ms. Gray. Well, is your best sector that you have the highest expectations for, and which country do you think has the most potential in the next 6 to 18 months?
I don't trust anybody who has an opinion on that. I'm not trying to set James up. I don't trust anybody who has an opinion on this as far as country or sector. I mean, you can see we're pretty consistent the way we approach this. You'll come across sectors that seem like they're depressed. We're looking for stuff that's out of favor. You know, I think Angola has tremendous potential. Okay, there's a reaction. But particularly in this macro environment, we're very careful about, we won't have any opinion as to what we expect in terms of macro developments, but that is not licensed to ignore what's going on around you. There's a difference between acknowledging the current reality and being foolish enough to think that you can predict the future. We won't do the latter, but it's incumbent upon us to do the former. And I think everyone would probably agree we're in pretty uncharted water right now in terms of the macro economy.
It is pretty volatile. Okay, James?
What? Slightly different. I think we think China right now has a lot of potential. And without getting into specific sectors or single names, if you just see how they're transitioning with Xi Jinping to less fixed asset investment, more what they all call quality growth as well, which is consumer and consumption-led growth, and the decisions they're making between delevering the banks, cleaning up the shadow banking system, that we find that China has a lot of interesting potential, and the consumer-facing companies inside of China are the bigger ones are positioned well to take advantage of this year.
So the CFA Institute just had its conference only a few weeks ago in Hong Kong, and some of us all went, and we were thrilled with the days of speakers that were keyed in onto the Asia area. And they were, it was like the good times and the bad times, as Charles, because there's so much they don't like their governance, but they do really think that there's growth potential, and if there's so much to be gained from them, but you need to be very, very careful.
Yeah,
But,
absolutely.
okay, there was a question in the back, sir?
Yes, James made a comment about fees, and I'm wondering what your fees are and your minimums. And I guess sort of as a follow-up to that, both of you, and as a follow-up to that, are you seeing any pressure to keep fees low?
There's definitely pressure on fees. We have several different products that have different price points, obviously. Our 40 Act funds, we have some guard here correct me, I think the fee on our EM product, our 40 Act is 108 basis points. I don't know what the Goldman product is, probably somewhere in that neighborhood as well, which are lower than, I think standards call 125 or so for EM. And then on the institutional side, obviously, it's going to be sub 1%. It's going to be, I would say, median or slightly below median. And again, the idea is we don't want to bring a client on and in a year have to have a conversation with them about our fees. We want the conversation to be purely about performance and what we're doing for them.
A minimum?
Minimums?
$1 million for institutional.
Institutional's $1 million. I don't know. The 40 acts are low.
Low for
Like
retail.
1,000 or 2,500 or something.
Oh,
GQGIX is the ticker for the EM 40 Act, and I don't remember the Goldman one, sorry. But it's the Goldman Sachs GQG International Equity Fund, I think.
same question.
As far as fees are concerned,
Fees and minimums.
we charge 1.5 and 20. We expect to bring the 1.5 down below 1 as we size up, just because fundamentally, and again, because of our investment strategy and the lack of a lockup or a gate, we really view our investors as partners. That's the type of capital we're looking for. I think one of the big mistakes that a lot of guys in our business make over and over again is that they fail to acknowledge the reality that high quality returns are inconsistent with low quality capital. And the question is, how do you get the high quality capital? And fundamentally, it's treating somebody as a partner. So we're pretty selective, but by way of our fees, for example, we want to bring the management fee down below 1% because we think it reflects more closely our actual costs. And we're not going to charge our investors because we're down here and it's just much less expensive to operate. We self-funded the launch of the fund. We didn't go to our LPs for reimbursement of our launch expenses. Our operations are totally self-funded. And in fact, because early on, although we negotiated pretty good admin fees, we didn't go with an NAV light where you have the full suite of services. We wound up carving out a portion of our performance fee and using it to reimburse our initial LPs. We rebated that money directly to them to decrease the impact of the admin fees because we thought it was just higher than it should be.
In the minimums?
The minimums are, we're more focused on the quality than the quantity. We'll talk to anyone. We're talking to, we've got individuals who approach us with $100,000 and we're talking to several Ivy League endowments right now. So we really, it's not marketing lingo. We really are focused on the quality.
Okay. Any other questions? Yes, sir.
What experience do you have with the quality of the account?
Experience, quality.
For the firms that you're buying?
The validity of the financial statements?
Earnings quality.
Earnings
Earnings
quality.
quality, forensic accounting.
It's a case-by-case basis, obviously. I can think of a name, I won't tell you the name of the company, but there's a company in India that we had met with, and they had put forth certain expectations of how they were compensating their employees, and our investigative journalist did some work on the name and found out that it was not as they were putting themselves out there. So we had originally bought a position and then turned around and sold it a couple months later as a result of this lack of earnings quality or comfort with the management team. And the stock ended up going up 4x after we sold. And then recently, within the last 6 months, news flow started coming out about the quality of their accounting and their business. And it went limit down every day. India has limits. So it ended up going limit down. I think now it's even below where we were originally looking at.
Again, I think we have a strategic advantage when you only need to find 10 to 20 investment opportunities. If anything smells even remotely fishy, you just avoid it, but we tend to drill pretty deep. If we're looking at a financial institution, we'll try to get through their loan book to the underlying real estate. I don't know if you're aware, but you know, they talk about after the whole market blow up how all these CEOs got away with murder. There was one bank CEO who went to jail. He's in Leavenworth. His name is Gil Lundstrom. He was the CEO of Tier 1 Bank in Nebraska. And I was contacted by the FBI and the DOJ and was flown out and spent a week in Lincoln testifying against him because somehow they got their hands on the research that I'd done and wanted to put it in front of the jury. So again, we say 200 to 400 hours. We do really, really drill down. You know, as far as any, like an American company, the SEC filings, the first thing we do is download all of them into a single Word document and read it. If you do that with St. Joe, for example, is the name we've been involved with, I can tell you it's over 23,000 pages because we have that document and we read it. And we also visited every piece of dirt they own.
Yes, Bill?
And that gets into the question whether the motorcycle is still a key element in your research process, because I recall you did a lot of on the ground or on the road investigation of their trees throughout the state of Florida properties.
Yeah, I've got about 150,000 miles now on bikes, and I just got married in March, and I told my fiance, you know, ground rules, the bikes stay. It's a little challenging down here with the drivers and, you know, their phones and everything else, but yeah, we still get out and do it. I mean, you know, Jim Rogers was one of my mentors. He used to say, you know, if you want to know, like, how did he put it? If you want to be, you know, like basically half misled, talk to the chairman. And if you want to be totally misled, talk to the CEO. You know, I think there's an inclination to believe that if you go out there, then you've covered the bases. And that doesn't necessarily accomplish what the end goal is. So we do go out, we meet with management, we'll talk with people. Some of the forensic stuff that he's talking about, I'll talk to journalists, go to a lot of kind of off-the-run resources and sources of information. But we don't necessarily believe that the CEO is going to tell us what we need. I've yet to meet a CEO who I went to, you know, presentation, and then afterwards, you know, he came over and said, you know, between you and me, we're screwed. You know, they never think that they're in trouble. It's only when, you know, trouble is descending upon them and it's unmistakable that they start talking about, you know, the issues they have to contend with.
Well, it is about 7:30, which is when we're supposed to wrap up. I'm going to take one more question, and then I'm going to ask the gentleman if they'd stay after our dismissal time. And Mr. Murphy looks like he really wants to ask you a question.
So I started and I'll end now. To the extent valuation is a focus or component of what you do, one pitfall for value investors is being in too early, even if you're ultimately right. Have you found any tools to help prevent early loss where it's going down, and if you figure it out, something to help delay the entry period until it's stabilized or shows something so you wouldn't have that early loss?
No. I mean, there is, you know, I guess, well, the answer is no. But the phenomenon that you're talking about, which everybody faces, because either you have the ability to call the bottom or you're going to be wrong, and nobody can call the bottom. We've never called the bottom or even remotely gotten close to the bottom on anything that we've gone long. It's why you leg into a trade. I remember talking with Stan Druckenmiller once, and he was talking about how he made investment decisions based on fundamentals, but he looked at technical factors in terms of how he handled the position. And we will look at how things trade, we'll look at the constituency, we'll look at what's going on in the market to try to be intelligent and adroit on how we put the position on and maximize our return. But there's no predicting. You know, you look at things like, well, you know, if there's an earnings event coming up, there's certain things you want to be cognizant of and take into account, and you'll maybe, you know, prognosticate a little bit, but you're never going to get it right, and that's why you generally very rarely put on a position fully, no matter how attractive you are at the outset.
James?
I mean, valuation is probably the least of our considerations, but it's just in terms of portfolio structure, we'll tend to put on a, call it a 50 basis point position. Even if we're not completely done with our work, it kind of forces you to keep that much more of an eye on the name once you own a little bit of it. So we kind of like plant those seeds with a bunch of smaller little positions and monitor them and get comfortable with what the story is. And from there, we'll upsize it or get out of it if it's not working well.
Okay, Bill? Like Phil's
Yes.
allowed to break the rules, he's part of it.
Two issues that may not have been brought up, and that is selling too soon, which has typically been the major mistakes I've made. And paying on for my clients is a source of creating a lot of wealth for my clients. So I'm with myself. And so I wanted your perspective on that in terms of, you know, years of experience, and I guess I've got about 50 years of experience. And my father was self-made millionaire with stocks, but he always sold too soon. And much like Buffett's experience being Benjamin Graham, he was selling too soon until he met Charlie Munger, who was a decade older than him, and pointed out the key to understanding the quality of the company and sustainability of its franchise. Getting on that train where you don't have to pay taxes and you can keep running it.
Well, you know, Lord Rothschild famously said he always sold too soon as well. A lot of wealthy people do that.
I think that was J.P. Morgan. How are you?
J.P. Morgan.
How are you? How did you make all the money?
Yeah, but, you know, so there is that. You know, some of it comes down to the nature of your capital too. If we were not running a fund but a conglomerate that constantly provided us with free cash flow, regardless of what the market was doing, we probably would have held on to Remy Cointreau because it's a great company and it's destined to probably trade down, but it's a one-of-a-kind asset. But I think institutional investors in particular, but any investor in the fund should expect us to handle things the way we do in terms of managing risk of the portfolio, harvesting gains.
I think Lord Rothschild's full quote goes, you buy when there's blood in the streets, and you sell when the brass bands are celebrating the victories. And that was what I was brought up on, not quite that quote. But then I learned the significance of growth investing. So that's my other question. How does it feel to be the end of momentum and growth investing has been dominant for 10 or 12 years? So you guys are operating slightly different from the majority. How much pressure does that put on the lower rate? Because you mentioned, about fees and major pressure in the last couple of years has been bringing fees down almost across the board in mutual fund companies and other managers.
How do you handle the pressure?
Well, I guess from our perspective is our strategy is kind of a barbell. On a value name, it'll be a function of so cheap you can't ignore. You're willing to take slightly less growth because you're being compensated by a much cheaper stock. But we'll also, on the other end of that barbell, pay up for a high growth company because ultimately our view is you make money in stocks by earnings and earnings growth, not on valuation and revaluation of the multiple for that stock. So if you're able to find high growth companies, again, at a reasonable price that have high growth potential, or a slightly lower growth company that has much better value associated with it, you can structure a portfolio that kind of can weather the growth versus value dichotomy. The problem is when you have a name in the middle that's not really growing very much and not really cheap relative to the rest of the sector, Those are the names you avoid because those are the ones you get in trouble with.
Well, I think we should all take a moment and thank our two excellent speakers for their presentation.